Welcome to Force Financial. I'm your host, Trainer Dave, and today we're going to talk about stock investing. This will be the first in a series of videos discussing investing in stocks, and in my opinion, there are two principal reasons to buy a stock. Either one for income or two for growth. It is possible some stocks have both characteristics. What I like to do is classify my stock investments as either income or growth stocks. This helps me define my objective for each stock. When I talk about income stocks, I'm talking about stocks that pay a dividend, because that's the principal way you're looking to make your money, by that dividend. You're not too concerned the stock goes up in value or goes down in value. Of course, you want to get that appreciation as another way to make money, and of course, you don't want the stock going down. But as long as they're paying the dividend, that's the principal reason to buy these stocks, and that's your goal, is to accumulate income. Now, I personally like to accumulate a portfolio of income stock, dividend-paying stocks, because I look for that in the future to supplement my income when I retire. So I look for stocks that have a history of paying dividends, and not only paying their dividends, but also raising their dividends. Many companies have a long track record of raising their dividend every year. So here we have some examples of some really good dividend stocks. AT&T, Altria, which is a tobacco company, ExxonMobil, the big oil and gas company, Coca-Cola, Clorox, McDonald's, even Apple. And as you can see on this chart, the dividend per share is the amount they pay each share per year. And most of these stocks pay quarterly, so if you want the quarterly dividend, just divide that by 4. And then you have the price there and the dividend yield. The yield is simply the price divided by the dividend. And as the price goes up, the yield goes down, and as the price falls, the yield goes up. Now, when you see a stock going down, that's a good thing because you can get a higher yield. You know, you put $1,000 in a stock that's gone down 10%, your yield now is higher. You're going to get more dividends. But you have to ask yourself, is that stock going down because a dividend is at risk? If you look at General Electric recently, that's what happened. So here's an example, just looking at AT&T to get a little closer. We see that red circle, and that is their dividend, $2 per year. And that is their new declared dividend. That was not the $1.80 we saw because they raised their dividend. And that is their forward yield of 5.8%. All these numbers, by the way, come from Yahoo. A growth stock is defined principally by your way to make money on a growth stock is because of capital appreciation. So you're looking for that stock to go up in value. If it pays a dividend, great, but you don't care about the dividend. You're just looking for the stock price to go up. Now, you can't have a income stock if there's no dividend. So you can see on this chart, every stock on here but Apple pays a dividend. So you're not going to buy Netflix for the dividend because there is no dividend. But we have some of the more famous, more popular growth stocks that a lot of people are in. You have your FANG stocks, Facebook, Amazon, Netflix, Google. I included Celgene, which used to be an in vogue stock. That's a pharmaceutical company. And we have Tesla, another high growth or high beta, as they say, stock. And when we look at Tesla's chart, we see the forward dividend and its yield is non-applicable because there is none. So again, you're not going to buy Tesla for the dividend. You're going to only buy this stock because you're hoping it goes up in price. That is the principal reason to buy a growth stock. Now, one more thing to highlight here is on these charts, I put the PE ratio. And the PE ratio is the price per earnings. And this is just a way to look at the value of the company. And I put the forward PE ratio just to illustrate how the growth companies have a high PE, meaning that investors are expecting very high growth for these companies, which is one reason why these prices are so high. And you've seen Netflix and Amazon and Tesla hit close to their all-time highs recently because people are looking for that growth. And if you look at the income stocks, you can see the PE is much lower because people don't expect Coca-Cola to double its customer base, right? Or Clorox to suddenly match the growth of Netflix. It's just, those companies are very mature, and those companies are more what you might call the value companies, or I call them income stocks because they're their dividend. So I wanted to illustrate the power of dividends and how they can help also your overall return. Here's the 5-year chart for AT&T. And AT&T had a price of $34.47 5 years ago, and now the price is $33.15. So the prices, they've actually gone down almost 4%. But because you've been collecting that dividend over those 5 years, this is how much money you would have. You would have $275. This is assuming you put $1,000 in, you bought 29 shares, and you got your quarterly dividend over those 5 years. You have $275 now. So over those 5 years, your portfolio, if you just kept that money there in your trading account, you'd have $1,200. The value of the stock has gone down to $928, but you have your dividends of $275. So you're at $1,200 for a total gain of $238, or almost a 25% gain over those 5 years, despite the price going down. And that's the power that dividends give you. Another good example that shows how appreciation can also help a dividend stock is McDonald's. So this is 5 years ago, June 2013, and we see McDonald's is pretty range bound. It was $99 in 2013, and then September 2015, it's about $99. So you were just collecting your dividend. It's gone up and down, but you don't care. You just got that dividend over that time period. Then McDonald's announced their all-day breakfast, and holy cow, the stock skyrocketed from $99 all the way to $166. So now we look at the 5-year chart, we see McDonald's has gone up 71% over that 5-year period, and that's not counting the dividend. So that dividend, is why you bought McDonald's, because you weren't expecting the stock to grow like an Amazon or a Google, but holy cow, it did. So that's one of the great things about dividend stocks. Sometimes you get this really nice appreciation on top of your dividends. And then I want to show the chart for Tesla, and this is where this is a 1-year chart, and you can see the up and downs of Tesla. So this is the risk of buying a growth stock. There's no dividends here, so you're just buying this stock on the hope of capital appreciation. If you bought Tesla a year ago, you paid $361. It's worth $358 today. That means over that year, you've made no money, and you're actually down a little bit. If you had AT&T or McDonald's, we saw, you were getting a dividend on top of that to help mitigate that. So when buying a growth stock, you really have to do your homework, and price really matters much more in a growth stock, because you can see you could have got Tesla, almost at $250. Imagine if you had bought it in April of this year, you would have made $100 almost on that purchase. So that's the volatility of a stock like Tesla. I personally own Tesla, and I personally own all the stocks that I mentioned here, just full disclosure. But I hope these charts illustrate the income versus growth dynamic. So I hope you enjoyed this video. There'll be more coming shortly. Until next time, I'm Commander Dave. Thank you.